Hi friends, CA Damodaram Pagadala is here. Today I am going to give you overview of entire partnership accounts. This partnership account chapter is very important in our life. We study the same chapter in 12th standard and after that in UG and PG and even after that in a professional courses like CA, CMA, CS, we study in all the levels. And even after our education, when we settle down in our life, when we start our career in the form of business profession, we do in partnership firm business. Many of the business nowadays started in the form of partnership firm. So this is very important both from the exam side and also from the practical side. Now, the entire chapter, whatever we study from school level till the professional courses, completely divided into two parts. The part 1 deals with change in the relationship among the partners. The other side, part 2 deals with change in the firm. So, from school level till the professional courses, whatever we studied at the basic level, change in the relationship among the partners. Now, the higher end, when you see advanced issues in partnership accounts, we deal with change in the firm itself. In this video, I am going to cover only part 1. I'll be releasing another video later on part 2. Let's come to the part 1. What do you mean by change in the relationship among the partners? So here, already partners have some understanding, mutual discussion that documented in the partnership deed. They have gone through with certain terms and conditions clearly understood. Based on the terms mentioned in the partnership deed, the firm is actually running. So let's take one term for example to understand. Profit sharing ratio between two partners 1:2 ratio. Let's take A and B partner. A is to B is equal to 1:2 ratio. Now what will happen? Suddenly this profit sharing ratio change. Anything can be changed in the future. The partnership deed can be amended at any point of time subject to mutual understanding among all the partners. Now we are going to see if there is a change, how this is going to affect the partners relationship and the future transactions of the firm. Now there are 4 situations which will change the relationship among the partners. First one, change in profit sharing ratio. It means already partners decided one profit sharing ratio. That ratio is going to change among the existing partners. Either they'll change to a higher end profit sharing ratio or lower, or they may equalize the profit sharing ratio. So that definitely is going to affect the relationship among the partners. Because of that, one partner will get higher profit sharing ratio compared to earlier. The other partner is going to get less. So here one person is going to gain, the other person is going to sacrifice. Nobody here will sacrifice at free of cost. So when they sacrifice, definitely they will expect something from the gaining partner to compensate. That is a rule in partnership accounts. So the firm's responsibility to collect something from gaining partner and give that to compensate the sacrificing partner. The same thing is going to happen in the other 3 situations also. Let's take the second situation where entirely a new partner is coming inside. It's called admission. Say already A and B partners sharing 1:2 ratio. The entire profits both are sharing in 1:2 ratio. Now suddenly a C partner is coming inside. Now what will happen? These people profit sharing is getting disturbed and C is going to take some ratio. That ratio either A or B are together going to sacrifice. Now what will happen here? Who is gaining is the incoming partner. He is supposed to compensate the other old partners who sacrificed. Now let's take the third situation where one partner, because of the age factor or some other reason, he retires from the firm. He is leaving the firm. No more is going to be partner in the firm in future. So what will happen? The moment he leaves, his profit sharing ratio will be gained by the partners who is going to continue in the firm. Now the person who is leaving the firm is sacrificing and the partners who is going to continue, they are gaining. So now again the same rule, gaining partner should compensate the sacrificing partner. So the continuing partner should compensate the retiring partner who is leaving. Now let's take the fourth, death. It happens naturally. So when death happens, just like retirement, in death also the deceased partner is leaving the firm. Now his profit sharing ratio is sacrificing, the continuing partners is going to gain. Now, under four situations, the relationship among the partners is getting changed. Because of that, one partner is gaining and the other partner is sacrificing. The rule is gaining partner should compensate the sacrificing partner. Now, up to this, it's clear. Now, in what the gaining partner should compensate, how much, how to compensate is the important thing in partnership accounts. Now, there are so many things we should take into account while compensating. In that, three major items gaining partner should compensate sacrificing partner is goodwill of the firm. Second is revaluation of assets. Third one is reserves and surplus. Why only these three items? Why can't be all the items? If you ask me, you take these three items deals with past performance of the firm. Now let's take goodwill. Say A and B partners, last 5 years they were running the firm. They gained so much name, goodwill, so many customers, revenue generated. Imagine the branding value today is 10 lakhs rupees. If A and B share, they'll share in their old ratio, 1:2 ratio, they will be gaining. Now suddenly another partner is joining C. Now what will happen in future? There will be three partners A, B, C. In future, after a partner joined, if the firm is sold to somebody else or a firm is getting closed, whatever value they are receiving for the brand, for the goodwill, will be shared by all the partners including the partner who joined. But actually who created the goodwill is old partners A and B. So that's the reason whenever there is a change in the relationship among the partners under four situations, immediately they will calculate the goodwill. That goodwill they will divide among the old partners. So whoever gained, they should bring to the extent how much they gained that amount and compensate to the sacrificing partners. Like that, let's take now second one, revaluation of assets and liabilities. Already there is a value. Now we have to do a revalue. What value already is there means in India we follow historical cost concept. It means we record all assets and liabilities over a period of time since beginning we purchased at their original historical cost. We never replace that value with the today's market value. So the assets and liabilities are not up to the value. Let's take an example. In 2000, say both the partners A and B purchased a land for rupees 1 lakh. But today, say imagine 2020, the value of the land is rupees 15 lakh. Now what will happen? The value is increasing somewhere else. Now the difference between this original cost and the market value, the difference is actually profit. If they sell the land, the entire profit what they got will be shared by the old partners. But suddenly what happens if a new partner join or even among the existing partners, their profit sharing ratio getting changed, what will happen? Some partners are going to gain, some partners are going to sacrifice. Now what will happen? Suddenly the partners who are existing partners, they compare the book value, original cost with the market value, and then they do a revaluation. In the revaluation, they compare all the assets and liabilities with book value with the market value. In that case, either the value may increase or decrease. If value increases, it's a profit, and decreases, it is a loss in case of assets, and vice versa in case of liabilities. That profit and loss again they will distribute among the partners either in the old ratio or the gaining partner will compensate and give it to the sacrificing partner. Same way, reserves and surplus. Who created the reserve surplus? By the old partners. Over a period of time in the past, whatever profit earned by the firm accumulated and they kept in the balance sheet. Suddenly when there is a change in the relationship among the partners, old partners decided to distribute the profits among the old partners. Then like this, in the first part of partnership accounts, there are four situations: change in profit sharing ratio, admission, retirement and death. Under four situations, some partners are gaining, some partners are sacrificing. The rule is gaining partner should compensate the sacrificing partner. In what and all they will compensate? Goodwill, revaluation of assets and liabilities, whatever profit they are gaining, and the reserves and surplus created in the past. Like this, the first part ends. Thank you. I hope you understood. I'll be giving you another video on the second part, and also I'm going to release videos on individual topics in partnership accounts very soon.